You're welcome to my channel. In this video we are going to be having an example of container accounts. So this is the question that we have. Yeah, that's the question. You can take a picture. So the question goes, Naisha Limited dispatches goods in returnable containers. We said we only prepare container accounts for returnable containers. So Naisha Limited dispatches goods in returnable containers, and the containers are bought from the manufacturer at UGX 15,000 each, but they are valued at 10,000 each. So this is the cost price. 15,000 is the cost price. We can summarize it here. Cost price is 15,000. Then they are valued at 10,000 each for stock purposes. So this is the depreciable value. Depreciable value, which is 10,000. Then customers are charged 25,000 per crate, at which UGX 20,000 is refunded when the crate is returned. So customers are charged 25,000 per crate. This is the charge out price. So charge out price is 25,000, at which UGX 20,000 is refunded when the crate is returned. So that is the credit back price. Of 20,000. Then at the beginning of the year 2023, Naisha Limited was holding. At the beginning of the year, it means that this is opening stock. Naisha Limited was holding 1,750 containers in the warehouse, then 1,460 containers in the hands of the customers. So this is opening stock in the warehouse. This is opening stock in the hands of the customers. Then during the year, Naisha Limited bought 2,000 crates. So purchase. crates. Bought 2,000 crates and charged out 5,663. So charged out 5,663 crates. Then 5,102 crates were returned by customers. So returned 5,102 crates. Then UGX 1.7 was obtained from selling 170 scrap containers. So this was scrap. So scrap was 170 containers, and they obtained 1.7 from it. Then 36 containers were returned by customers. 36 containers were retained, like they didn't bring them back. So retained 36 containers. Then UGX 257,000 was incurred to make damaged containers useful. So that is repair. Repair they incurred 257,000. Then the stock at the end of the year was 3,021 containers in the warehouse and 1,983 containers with customers. So this is the closing stock both at the premises and in the hands of the customers. So required, they want us to prepare the container stock account and the container suspense account. So we start with the container stock account. We said the container stock account records the stock in the warehouse and in the hands of the customers. So this is the formatting. We have details. We have quantity. We have rate. We have amount. Details. Quantity. Rate. Amount. So this is the debit side and this is the credit side. So let's also draw here the formatting of the container suspense account. Details. Quantity, rate, amount, details, quantity, rate, amount. Debit, credit. So according to the formatting of the container stock account, we said we start with the balance brought down or the opening balance. Then this side we have purchases and then repairs. This side we have scrap, containers kept, hire charge, then closing balance, like that. So that's what we do. The first thing we are having this side is the balance brought down, which is the opening stock with the warehouse, within the warehouse or the premises, and then with customers. So here it is. At the beginning of the year 2020, Nature Limited was holding 1,750 containers in the warehouse, so that is the quantity. Then 1,460 were in the hands of the customers, like that. Then according to the formatting, we said we multiply with the depreciable value, and according to our question, the depreciable value was 10,000. So here we multiply by 10,000. 10,000. So this times this, we get 17,700,000. Then here it's 14,600,000, like that. Then this side we said we also have purchases because they increase on the stock of containers. So purchases. What was purchased? we had 2,000 crates, so this is the quantity, and the cost price was 15,000. So 2,000 times 15,000, what we get is 30M. Then we have repairs. Repairs, they told us Yugi X 257,000 was incurred to make damaged containers useful. So here we only have the amount, so it's what we write here. So this side is done. We go to this side. This side we have containers kept or containers retained. Containers retained. And according to here, the containers that were retained were 36. 36, and we multiply with the credit back price. Credit back price, which is 20,000. So 20,000. That's what we get. Then we also have scrap. It told us they scrapped 170 containers, so that is the quantity at 1.7. So this is the amount. So 170 containers, the amount is 1.7. In order for us to get the rate, we just divide 1.7 divided by 170 containers, which is 10,000 each, like that. Then this side we also have hire charge. Hire charge, and for hire charge we said we multiply the containers sent times the difference between the charge out price and the credit back price. So hire charge, the difference between the charge out price, so charge out price minus credit back price, which is 25,000 minus 20,000, which is 5,000. So containers sent, this times 5,000. So 5663 times 5,000. What we get is 28,315. Like that. Then we also have the balance carried down, which is the closing balance. And they told us the stock at the end of the year was this in the warehouse and this with customers. So this is the quantity. So warehouse, it is 3021. Then with customers, it is 1983, like that. So we multiply with the depreciable value. So 10,000, 10,000, which is 30,210,000. And this is 19,830,000. Like that. Then after, you get the totals for the amount column for both sides, and you see which side is greater. So for this side it is 720, 4 zeros, plus 1.7, plus 28315 plus 3021 plus 1983 so for this side it is 80775 like that. Then we come to this side, it is 17,017,500 plus 14,600 plus 30M, the 7 zeros, plus 257. So this side is 62357. So this side is greater, which is 8077500, like that. So put the same amount here, 80775. That is it. Then we get this minus all these, the total for these. So this minus this, 80775. So the profit that becomes the profit, it is 18,480, like that. So that is the container stock account. Then we go to the container suspense account. We said it only records stock in the hands of the customers. So this is the formatting: balance brought down, then containers sent out on the credit side. So balance brought down in the hands of the customers, which is this only, so 1460. And we said in this account we multiply with the credit back price, this one, 20,000. So times 20,000, what we get, then we have containers sent out. Containers sent out, which is 5336. And this time we multiply with the charge out price. What you get is 1415, like that. Then on this side we have containers that are returned. They told us 5,102 crates were returned. We multiply by the credit back price, which is 20,000. Then we have the containers that were retained or kept by customers. They didn't bring them back. and in this case they were 36 times the credit back price, which is 20,000. Sorry, this was supposed to be 5,000 404 containers. According to the question, you pardon my mistake. 5,404 containers, like that. So this amount is going to change. 5,404 times 20,000. Oh, that's the right amount. Then what was retained? 36 times 20, which is 720. Like that. Then we also have the balance carried down only for customers, which is this 1983 times the credit back price, which is 20,000. What we get is 39. Like that. Then we balance off, we see which side is greater. So this side is greater, but it already has 141 M, so it is greater than this side. So when we add this and this, we get 170,775.00. We bring the same figure here, like that. Then we get this minus this minus this minus that. So 170,775 minus 3966 minus 720 minus 102.08. So what you get, that is the figure that you get. That figure should be the same as the higher charge that you got here. So which is it? It's the same as this. So that makes your work to be correct. So you write it here as the higher charge, which is 28,315,000, like that. So that is how we prepare the container accounts. Thanks for watching.